Hey, this is Josh. Today is Monday, July 31st. Today was a very crazy day. Friday was a pretty crazy day as well. I didn't have a chance to do a video Friday. If I get a chance, maybe I'll try to do one later this week. There was another trader asking some questions about Friday since it was a very interesting day. On Friday, there were a couple failed wedges, and the saga continued today with failed wedges. Pretty interesting. I came in this somewhere around in here. Prices were in this tight trading range. Market was always in short. The bears were unable to break. The bears were not breaking below lows strongly, and they were taking profits at lows. Bulls were buying lows and scaling in. And you can see the market went, I think, 2 pips below this low here, and then 1 pip below this low here. So bulls were buying at the lows, bears were taking profits at the lows. There was also a small weak bear channel in here. We had the break and then a 2-leg retest of the low, turned into a failed low 2 and a high 2 buy setup here. But you're buying on a stop in a limit order market, so best to take it as a swing. It's also in the middle of what was the small trading range. It's at the lower end, so you could argue that, but it was near the middle. So better to take it as a swing trade. But the bulls got follow through, entry and follow through. The market became always in long here, making this a weak low 1 after a buying below this bar here was a weak low 1 buy setup, weak low 1 sell setup. So reasonable to buy below with the limit order, and also there was a broader bear channel, so there was room left to the trend line, enough room for a scalp here, so reasonable to buy below there. Bulls got a strong bull breakout, turned into a buy the close bull trend. There's a high 1 buy setup here, but you're buying into the high of what was then the bear trend line. So I do not think that was a strong enough trade to take. However, the bulls did get strong breakout above here eventually and follow through. This was another weak sell setup, but at the time it was at the top of a trading range, so I avoid buying high in the trading range. So until there's a breakout, I'm looking to sell unless there's a strong reversal and a breakout like there was here. Turned into a steep tight bull micro channel, and this is when you see a tight channel like this, it's usually a spike on a higher time frame chart. And if you look at the 16-minute chart, it was a spike. This was another high 1 buy setup, failed bear reversal, but again, you're buying high. So if you want to take that for a swing, reasonable. At that time, the bull trend line was not clearly evident. I don't see it as being confirmed until here with three touches. So first touch, second, and then third. So this confirmed it. However, like I said, you're buying high in the trading range. So if you want to take this buy, you need to take it for a swing trade. So this was a weak low 2 sell setup, failed bear reversal from the breakout of the trading range. No strong sell signal for a failed breakout above the trading range. So okay to buy below here with a limit order for a scalp up. I think buying on a stop above the bar is riskier. If you're going to take it for a swing trade, probably okay, but in my opinion, it's a little risky. So the bears tried for a wedge reversal here. 1, 2, 3 pushes down, or 3 pushes up. 1, 2, 3 pushes up. Okay, signal bar. Bears got a poor entry bar. This was a weak high 1. The bears sold above. Bulls who had bought here scaled in, exited as well. Turned into an outside bear bar, but it turned into a failed 10 pip scalp for the bears. And so bears again lacked strong follow through, and prices again reversed off of this bull trend line. You may consider it a slight break. Either way, you're still looking for a retest of the high after the break of the bull trend line. This was a high 2 buy setup, but it was an outside bull bar. You're buying above a bear bar, and if you're expecting a failed wedge, it's an okay thing to do. But if you're taking this, I think you need to take it for a swing trade. You're buying into the high. Yes, it is a failed reversal, but you never know that this is going to happen. Most of the time, the wedge will not fail. This is a pretty rare occurrence, but like I said, Friday and today, for whatever reason, lots of failed wedges. So outside bull bar for the high two, bull entry bar, strong bull breakout, bull follow through. Look at this gap here. So prices, anybody who wanted to buy this close could not get filled. Prices did not even tick, did not even pull back 1 pip before rallying strongly. That's a sign of very strong and aggressive bulls. However, this was a buy climax. It was to a measured move up based on the height of the wedge, making this would have been a reasonable sell setup for the climax. Looking for 2 legs down. It did not work out. It did result in 2 minor legs down. The bears tried for a second entry here. Never really got a great signal bar for the second entry until over here, which was a failed high 2 and a low 2. But again, it did not trigger. So the bulls were so aggressive, the sell setup did not trigger. Instead, bull breakout above. Buying above here after the buy climax or the high 2 buy setup to me is risky because most high 2s after a climax fail, like over here. So pretty risky in my opinion to buy above here. But if you're going to take it for a swing trade, probably okay to do. On a strong trend day like this, you're going to have to buy into highs. So not unreasonable, but I do not consider a best entry. So second buy climax here. Strong bear reversal bar for the second buy climax and 2 legs down. So good swing short here. Looking for 2 legs down. Bears got good entry, good follow through. The market became always in short here for the second leg down. Also notice prices have not touched the EMA since back here. So very strong buying pressure. And look at the difference between here prices came within 1 pip of the EMA, and over here they did not come but maybe 3 or 4 pips from the EMA. This is also a sign of parabolic buying, so that gave more reason to enter this sell setup for looking for 2 legs down. This was a high 1 buy setup outside bull bar, but it's after a buy climax, so better to sell above with a limit order. Acceptable scalp to sell above, looking for a scalp down. And usually this results in a strong sell-off, like perhaps to here, like I've been saying, to the bottom of the second climax. However, today, filled with low probability events, similar to Friday, the bears never could generate enough strength. Yeah, there are consecutive bear bars closing near their lows, but look at the tails, and they're not going very far. The bears are not as strong as they could be. The bears could have, had they been strong enough, could have reversed this bar and tested below here. Instead, prices drifted mainly sideways down to the EMA. And this was a high. You could also sell above this bar. It was a weak high 2 buy setup after a climax. It's a bear bar. Reasonable to sell above there, looking for a scalp. I don't know that it made a scalper's profit. Yeah, it came up 1 tick short of, unless you sold up near here, you probably did not reach a scalper's profit. But look at what happened with the bull signal bars. So also one other thing to point out, in a strong trend, the signal bars are weak. Like so, here's the high 2 buy setup, it's a bear bar, weak, right? Same with over here, high 2 buy setup, it's a bear bar. And then look what happens after the climax. Strong Signal bars, but look at the follow through. It goes nowhere. It turns into a bear bar. So same with here. However, the bears could not trigger this failed high 4, large high 2 buy setup, and instead bulls got to break out above. This was a wedge bull flag. Not quite back to the EMA after a buy climax. You're looking for prices should at least come within. I would say I was expecting a test. sorry, I was expecting a test of the EMA here, especially after the parabolic buying from here. I was very surprised whenever prices could still not reach the EMA, but on a strong day like this, not uncommon for prices to hold away from the EMA as the bulls are buying any pullback near the EMA. So here's what the bulls tried for a failed failure wedge bull flag buy setup. Again, did not get good entry bar. However, the bears could not sell a market off strongly and form this high 4 buy setup. You can consider it a larger high 2. You can consider it 2 legs down from the sell climax, first leg, second leg, or first leg, second leg. Or you can consider this as the attempt of the second leg down. Either way, this was an okay swing buy. However, this is rare for prices to continue after a climax. Like I said, usually prices correct down to the bottom of the second climax. But you can't ignore it. And this was an okay buy setup here as well for a breakout pullback. Second entry for here. But not all that great. However, this was a weak low one. You can consider it I'm sorry. So bulls got not a great entry bar, bull follow through, but again, not going very far, mostly sideways. However, the bulls got decent follow through here from this entry, and also a small breakout of the small tight trading range here. So the market became flipped back to always in long here, making this a weak low 1 buy setup, or you can consider it a variant of a failed low 2, first entry, second entry. I would consider it a weak low 1 buy setup. It's a breakout pullback buy setup to the bottom of this bull flag. Okay to buy below here with a limit order for an acceptable scalp. Prices came up and tested this close and drifted back down. The bears tried for a lower high major trend reversal. It got good entry, good bear. The signal bar was weak, but good entry bar, a good follow through. Closed at the EMA, but instead of breaking below the EMA, bulls formed a failed reversal. You can consider it a double bottom bull flag with here. And then personally, I don't care too much for this because it's only a first entry for this buy setup, but buying above this second entry, reasonable to take for a swing. Prices have been holding off of the EMA, and now this trend line is formed. So okay, swing buy above this bar. Here is a failed low 2. Prices, it looked like they were forming a bear flag trading range, but instead the bulls got breakout above here. This was also a weak sell setup. You can consider buying below here with a limit order. I don't necessarily consider it being a best trade, but it's reasonable. If you're willing to scale in, you can call it a best trade, but at this time you're buying near the high of a trend channel, so a little risky. But when the bears could not, when this low 2 sell setup formed and the bears could not sell the market off, made this a failed low 2, reasonable swing buy, but you're buying in the high of the day. It's late in the day. Today is the end of the month, and the bulls want the month to close on its high, which this today made a new high, and as of now, it looks like they are going to get the close on the high, or at least around the high. Prices are now currently just going sideways in a small trading range. This was also a high 2 buy setup, reasonable, but like I said, this is late. I only trade until about 2, so I think I left right around. Today I stayed a little later because of the volatility and because it's the end of the month, but I think I left somewhere right around in here. But this was a reasonable high 2 buy setup as well if you were still trading. It's also a failed low 2. I've got quite a few questions to go through. I don't think I'm going to make it through all of them today, but I'll try to make it through a few of them today and finish the rest tomorrow. I also plan on doing a higher time frame review probably tomorrow. So look out for that. This might be pretty interesting. Okay, so first question, when there is some evidence that price will turn for 10 bars, 2 legs, after 10 bars, 2 legs, is it the start of a trading range, or does it mean the new direction? Really depends. I personally do not think in terms of 10 bars. I do think in terms of 2 legs. I forgot to mention, so I don't know if I mentioned this. So here was the wedge. The wedge reversal failed, and prices made a measured move up based on the height of the wedge. Something similar happened Friday, but sorry. So as far as 10 bars, 2 legs, I don't think in terms of 10 bars, but I do think in terms of 2 legs. So when there's a high probability of 2 legs, like here, I'm looking for 2 legs down. That does not necessarily mean a reversal. It just means two-leg correction. At that time, it can turn into a trading range, or it can turn into a reversal. Really depends on the day. Really depends on the price action. I would say most of the time, if it's a strong trend day like today, it's probably just going to evolve into a trading range. But if it's like a weak channel, then there's a potential of it turning into a reversal. Hopefully that answers the question. Next question. Do you only know that gaps will not close when you see the follow through, or are there ways to locate them? Yeah, no, yeah, pretty much you gotta wait until they're tested to know that it's not going to close. I would say that whenever, like if the bulls are clearly in control and forming gaps, like a big breakout gap here, and then the next gap forms like here, I would say that I would not expect this to get filled. I would expect it to become a measuring gap. As far as locating them, you just got to pay really close attention to the bars and the price action. There's not really an easy way of finding them before they occur or or before they're tested. So like here's another gap. Price has tried to fill the gap on this bar, on this next bar, and instead the bears could not fill the gap, and the bulls keep it open. But no, there's not really an easy way to locate them. Just basically, and I understand for a beginner it's hard to, because there's so much going on. It's hard to pay attention, but as you get better, you'll start to notice gaps as they're forming, and on the next bar you'll say, oh, okay, that gap didn't get filled, so it's a possible measuring gap. This was a likely exhaustion gap. However, the bears could not fill the gap, and it was left open as well. And I didn't check, but I imagine that prices probably made a measured move up based on somewhere near that gap. No, not quite, but we may get there. You never know. Okay, so next question. It's easy to say to get stopped out when your premise is wrong with breakout plus follow through against you, 3 consecutive bars, etc. But if you don't rely on your price action stop loss, there are a lot of times in which prices will reverse in just one bar and goes the exact place where you anticipated. What I mean is it's easy to get stopped out. Yeah, and that goes back to removing emotions and remaining objective. You have to understand that one bar going against you does not mean you should exit. When I say breakout with follow through, I mean like here. So you can consider this is the breakout of the bull flag, and this is the follow through, or this is the breakout of the bull trend channel, and this is the follow through. But it's also a buy climax, so not a great example. I'll try to find a better one. So prices here, we're in a tight trading range, small bear channel, tight trading range, whichever you prefer to call it. Bulls got a breakout above, and then bulls got follow through here, so which I had sold above here. So whenever I see that, I'm looking to get out. So it's not just when one bar goes against you, it's whenever there's follow through against you is when you exit, or when there's 3 consecutive bars, like 1, 2, 3 bars, right, against you. So you need to get out. But if one bar goes against you, that doesn't really necessarily. Sorry, but so when one bar goes against you, it doesn't necessarily mean you need to get out. Mainly follow through against you. Um, I or if your premise if your premise is wrong, but basically if there's follow through against you or breakout against you, if you're using a tight stop like a 10 pip stop, then I would say just rely on your stop, because it's very easy to get trapped out of trades, out of good trades, and that's just due to there never being a clear. You got to always remember there's the 60-40 rule. So if you keep that in mind, I think that'll help, and try not to get upset when prices are going against you, because prices don't always go in your favor immediately. It takes time to get used to it, but hopefully that answers the question. Or back to that question. So if the always in direction flips, then you need to get out. So next question. What are your thoughts about entering on a reasonable bounce and let price go the way of your entry and putting a break-even stop? Well, it depends on what style of trader you are. If you're an always-in trader, you can't really use a break-even stop unless prices have gone in your direction a reasonable ways. And so say you buy this close, your stop's down here, and now prices might make a higher low. You can put your stop below here, or you could consider moving it to break even. If you're a swing trader, I think that it's common to put your stop at break even, but you have to remember it's after. You have to. A swing trader is looking for two legs, so the first pullback you can't move your stop to break even. After the second leg has begun, then you can move your stop to break even. But as far as putting it, if you're a scalper, I don't think you're probably ever gonna. The only time you put your stop at break even is whenever price is like 1 pip away from your target, and you're waiting to get filled. I tend to just rely on my stop where it's at. But if I'm if you're a swing trader, then once the first leg has gone in your favor and there's a pullback and it tests your entry price and the second leg has begun, then it's okay to move your stop to break even. But even then, you got to be careful, because you'll get stopped out of a good trade. Like I talked about the other day, entry prices get tested often. Like here was a reasonable buy setup. Price, if you had moved your stop to break even, prices would have likely stopped you out. But it's not a great example, because you probably would have taken profits below here. But just remember that prices often come back and test the entry price. So break-even stops don't always play out the way that you would like. So personally, I think it's better to rely on a stop. It's okay to tighten your stop to maybe beyond the entry bar. But as far as a break-even stop, I think that you'll stop yourself out prematurely, or break even after it's not smart to risk your money and then exit break even when you put your money on the line. So personally, I rely on my stop, but it is okay to tighten your stop once prices go in your favor, like beyond the entry bar, or if you're a scalper, once prices are within a pip or so of your target, then it makes sense to move your stop to break even while you're waiting to get filled. But as far as trying to do it on a regular basis, I don't think that it's a great strategy. I do know that there are other people out there like Mac who is all about tightening his stop to break even, but which there's another question I'll get to tomorrow, which has to do with stuff like that. So that's about it for today. I don't have much time. So really strong bull trend day, bull trend from the open. Really interesting price action the past couple of days, and on the higher time frame charts, we're getting a strong breakout. So I'll try to do a higher time frame review maybe tomorrow. All right, hope you guys have a good night.